Welcome to Deal Talk, a private equity podcast by Moonfair. Each episode, our CEO, Dr. Stefan Pauls, sits down with leaders from across the industry to discuss their views on the investment landscape, working with portfolio companies, and the lessons they've learned.
Good morning, good afternoon, good evening, everyone. A very warm welcome from my end to Moonfair's Deal Talk episode today. Quickly, let me introduce myself. My name is Stefan Pauls. I'm the founder and CEO of Moonfair. And quickly look, for those that are less familiar about Moonfair, what we do is simple. We are, in the meantime, the largest direct-to-consumer digital private equity platform in the world, accessible in over 23 countries across the globe. And we are spearheading what the industry is referring to as the democratization of private equity. This is actually our mission. Moonfair gives private individuals the opportunity to invest directly into some of the most sought after private equity growth and tech funds from managers such as KKR, Premier, Insight, Silver Lake, and many more. And all this starting at low minimums. Depending on your jurisdiction, it starts as little as 50K. And this is all done through an entirely digitalized process. So if you would go now to the Moonfair platform, it takes you less than 2 minutes to sign up, and you can view our funds. Today, I'm excited to welcoming a guest with a very unusual background, David Fialkow. As a venture capitalist and an Academy Award-winning documentary filmmaker and producer, David loves working with creative people and helping them having real impact. Before David and Joel Cutler co-founded General Catalyst, they built and sold 4 companies, including National Leisure Group and Alliance Development Group, and others. David's career reads very differently from other people in the venture and private equity industry. David studied film at Colgate University. He earned a law degree from Boston College and made documentary films. Together with his wife, Nina, David makes documentaries focused on healthcare and social justice, and with a huge success. Their film Icarus won the Academy Award in 2018 for the best documentary film. David, it's an honor to have you join us today in our Deal Talk. Not only you have launched a number of very successful businesses and co-founded General Catalyst, but also you have produced, as I said, an award-winning documentary. We are super interested in hearing first, a little bit more about each of these experiences. But before we get started, any new documentaries in the pipeline that we can be in the lookout for?
Yes. First of all, thank you for having me. It is my honor. Yeah. I mean, the goal of filmmaking for us is to tell stories that people want to know. And in many ways, the venture capital business and dealing with entrepreneurs and helping entrepreneurs in their journey of building their companies is very similar to documentary filmmaking. You want to have an arc of a story. You want to be able to tell people exactly what they want to know, bring up information and ideas that people didn't know. And we'll talk later about venture capital, but in many ways, that's why documentary filmmaking and venture capital is so similar, because of the storytelling and the ability to focus in on very interesting people. So that's where these two worlds come together. Most of the films that Nina and I make, as you said, are focused around social justice. Our most recent film, Navalny, tells the story of Alexei Navalny, the Russian opposition leader who's been jailed by Putin for speaking out. And he was also poisoned a couple of years ago with an attempt to be Putin to kill him. And he came back to Russia last year to face his country and to tell the country that he was there to lead. And then Putin decided to jail him again. But we wanted to tell that story because this is way before the Ukraine situation, but we wanted to tell the story of a leader who cared so much about his people that he was willing to come back and face the consequences. Some of the other films that we have out right now is one film called The Grab, which was featured at the Toronto Film Festival last weekend. And it's a story about how certain countries of the world have been simultaneously buying U.S. agricultural assets as a way to feed themselves, and by doing so, creating a supply chain issue in the United States around food and around pork and around agriculture. Our most recent film is also two films about, you mentioned healthcare justice. One that's called Aftershock, which chronicles the stories of how difficult it is in low-income areas to do delivery of babies, and the mortality rate in maternity wards in low-income areas in the United States is extraordinary. And it's a story that has to get told because we want healthcare equality for everybody, and it's just not happening in the United States. And then lastly, we have a film that we got nominated tonight, is the Emmy Awards here in New York. I'm very excited we got nominated for a film that we made that's called The First Wave. And The First Wave was the first 2 months of the COVID pandemic in New York at a hospital called Long Island Jewish in the Bronx that struggled mightily to keep many patients alive. And again, because of the issues around inequality in the American healthcare system, we chronicled how difficult it was for low-income people to get access to great healthcare, ending in major deaths. We have another film coming out next week. Busy month, right? About Boeing, chronicling the story of the 737 MAX and some extraordinary bad behavior by the leadership team and the board of the Boeing Corporation to allow a plane to fly that there was prima facie evidence was unsafe, leading to 2 major crashes, killing several hundreds of people, and Boeing not owning up to the mistakes that they made. Now, instead of making claims, the best thing to do is to prove this. And the way that our films usually work is somebody will tell us a story. For example, another feature series we have coming out in a month is called The Vow. And that's probably a good example. And I'll keep talking about films until you tell me not to.
Well, this is fascinating, David. It's really fascinating. And if I may say, being an entrepreneur myself, I admire and a ton of respect how you and Nina and you personally get all this together with your main job at General Catalyst. Let us talk a little bit about General Catalyst and the current market environment. And let me kick it off with your quite unique investment approach, which is very much centered around how General Catalyst really helped the journey of their founders. And for those in the audience less familiar with it, can you please briefly outline your philosophy around being founder-centric, how you support them, what it is actually, because many claim we support our founders, but what is it actually what differentiates you in your approach?
Thank you. So part of this is let me talk for a few moments about what our original idea was, and then how that's transformed into something quite different. Joel and I had built 4 companies, never using venture capital money. Now, the reality is that some of the businesses that we built required venture capital. I wish we had access to it, and some of them didn't. And one of the things that always bothered us is that the investor base of venture capital firms years ago did not focus on exactly what you just said, the journey of founders. It was purely economic. What were going to be your returns, show us your business plan, et cetera. And great founders don't often know where they're heading. What they know is they love their product and they want to go do something, and they want a partner who will be on the journey with them. So when Joel and I sold our 4th company 20 years ago, we wanted to make a platform that would allow other founders to seamlessly be able to create businesses, be able to pivot. The other point that I'll get to is, you mentioned Icarus as a film. Icarus started out as a movie about my friend racing his bicycle, and the film, the early part of the film kind of failed because our premise did not work, and we had to pivot. And we pivoted the film to make a documentary about the Russian doping scandal. And just like venture capital and film together, sometimes you go out and you have a really good idea and you start down a path and you have to pivot because the market changes, the product changes, the environment changes, whatever it is. And you need an investor who's going to be focused on the long-term outcome of the company and is going to embrace that pivot, embrace the changes that happen in the business. And we want to build General Catalyst as a platform that would be entrepreneur and founder friendly to be able to do that. We had no idea that we would build the firm that we have today, but we got three things really right. Number one, we built a great team around us, and we continue to do that. This is not a sole practitioner business. We win because we have a great team. And in particular, the leadership team that we have in place today, which we'll talk about, has done an extraordinary job to do that. But what our original idea is let us be really focused around what it takes to help start a business, nurture a business, build a business, and all of the creativity and pivots that come, we would embrace and be on that journey with founders. So the original idea was very similar to what we do today. Find extraordinary people, give them the resources, the empathy, most importantly, the encouragement and the resources to go do and build their businesses. So at the time, the market was quite different. There were a lot less opportunities, and therefore most of the firms kind of dominated with the fact that they had capital and it was less founder friendly. We wanted to change that model.
Very helpful insights, David. Look, both of you and Joe, you're both entrepreneurs, and entrepreneurs tend to be pretty strong when it comes to decision-making. Can you elaborate a little bit on how the decision-making process when it comes to new investments work at General Catalyst?
There are four things that you should never see made: home construction, sausages, documentary films, and decisions in a venture firm. The way that General Catalyst operates is we do not have an investment committee. We do not put ourselves in a situation where one or two people can derail a deal, or by the same token, people will not speak their mind because fearful that they're going to vote against the deal. Yeah. Instead, what we do to get granular is we allow our partners to be creative. And one of the ways that we create a lot of our deal flow is that we hatch a lot of our own businesses. So many of our largest wins, come from deals that we hatched, meaning we either had an idea and we brought founders in, or founders brought us in at the absolute inception of a company. And the reason why we love to do that is that it allows us to control in a better way the relationship with that founder to be able to build that business without the distraction of potentially other investors or having to worry about fundraising, et cetera. So directly answer your question, when it comes to hatching a business, which is a big part of what we do, we encourage our team, which is quite significant in its diversity in terms of skills and creativity, to bring to the partnership big ideas that we ask only a very simple question. And we say, if you're right, will you get paid? And that is a great way to do it. And then the second thing we ask is this founder somebody that we want to be a partner with for 10 or 15 years? Because with the exception of very brief times in our history, most of the great companies are built over a very long period of time. So if you're in a situation where you want to back a founder over a long period of time, don't sweat about what the first month or year looks like in a company. Just make sure that that founder is doing four things really well. Is he or she listening, taking in input? Are they building a great team? Are they focused around their product? And most importantly, do they have the fortitude and the drive and the willingness to continue to work and create over a very, very long period of time. So the direct answer to your question is about decisioning. We give a lot of deference to our partners. If one of our partners really wants to build a business here or invest in a business, we will collaborate with that partner in a small group and allow a small group to make the decision on whether or not that's a deal that we should go forward on. However, now more than ever, let me bring up the other side of what I just said. It is a lot easier for us to invest in a business than to do a follow-on, because at the beginning or the inception of a business, we're all optimistic. We love the people we're working with. We have a vision, and we set out on the road to do things. And we will build metrics that allow us to understand, is this business moving in the right direction? Yet also understanding, as I mentioned before, that businesses pivot and a change is a wonderful thing. The second part of it is, when do we put more money in? And that's where the decisioning gets a little bit more tougher, because we have three things. Number one, we have experience with that founder. And the first question we ask is this a founder that we want to back and continue to back? Because a follow-on is still a new investment. It's still new capital from our investors. And we are given, we have a fiduciary responsibility to make sure that we don't put good dollars after bad. And one of the real problems in the venture industry, when you look at returns, is how many firms just put too much money into, frankly, bad deals. So where we've gotten much better, we certainly didn't do this at the beginning, is being really analytical and thoughtful and have what we would call constructive confrontation within the partnership to say, it's not David's deal or Joel's deal or Emily's deal, it's a General Catalyst deal. And we do not want one or two partners to advocate only for a follow-on investment in their own companies. Instead, what we want is a small team of people to really be deeply thoughtful, looking at the experience and the data and the potential of each and every deal that we do. And that, to me, is the real maturity of how we built General Catalyst. Thoughtful and creative at the beginning of a process, totally understanding of the journey of a founder, but really understand which businesses we want to be in the long term.
David, very helpful. And of course, that involves quite a couple of tough decisions, being a founder-centric company and then suddenly not able to back them anymore because you're not believing anymore in their businesses. Many things, by the way, you said are very much resonating at KKR. Henry Kravis, and you know him, he said always, we only want to do business with people whom we trust, whom we respect, and whom we like. That's it. And it couldn't be a great company, but if we don't respect these people and like them, we don't do it. Look, I think
let me just add one thing, because you just set up something else. The second part of this is, just because I think that this is tactful, and you're putting me to answer your question. The second piece of this, so we have constructive confrontation within the partnership, which says it's not personal. If I challenge your deal, it's not that I don't love you. It's actually I love you more because I want you to be successful. And we all take things personally. It's hard not to. Fortunately for me, I grew up as a hockey player, and I'm accustomed to people hitting me. But the second piece of this is what we call responsible innovation. And 4 years ago, we added a leader to our firm named Ken Chenault. And Ken Chenault ran American Express. And you'd say, why would a guy that ran American Express fit in an early stage venture capital firm? But what Ken brought us was an extraordinary history of great leadership. And one of the things that's often lacking in any business, including ours, our industry, and including at times General Catalyst, is really good leadership. And what Ken brought us is an amazing way to look at the world, which is, are the companies that we building, are we proud to be with those founders? Are we proud of the work that they're doing? Are they actually doing things that's responsible in their innovation? Are they just attacking a market as another player in the market, which isn't going to make the pie bigger? Do we have to go steal people from other places in order to make things work? Are we doing companies that we're not proud of building because they don't make the world a better place? That led us deeply into healthcare. That led us deeply into fintech, because those were areas that we felt were really broken. Now, again, this sounds like a really good interview, arcs coming together, but they are. So the exact way that we build our documentary film business is very similar to the way that we build General Catalyst, which is tell the stories that people want to know, build the companies that society and the world really needs. And when we looked at healthcare, 5 years ago, up until about 5 years ago, all the cool kids didn't want to be in healthcare. And I'm talking more America than probably anywhere else. It was, laden with red tape. It was bureaucratic. There were too many layers. It was just blah. It wasn't interesting. You couldn't get anything done. But three things changed that. Number one, technology. It made it easier. Things like using artificial intelligence, telemedicine, using computing power to create drugs, using creative ways to do. We have a company that's located in Portugal that's the largest player in the world in remote physical therapy by creating a platform that allows people. This is an amazing idea. Again, I'm American, right? So if you blow your shoulder out and you need to go and get physical therapy, and the doctor says you got to go 7 times. Well, if the therapy is an hour and it takes a half hour each way to get there, and then you have to futz around for a little while, it's 3 hours to get an hour appointment. That's 21 hours. So most people say after 1 or 2 sessions, screw it, I don't want to do it anymore. And what happens is their shoulder doesn't get better. They continue to get hurt. Our healthcare costs go up through the wazoo. So how do you change that? We built, our company Sword that's located in Portugal. Why Portugal? Because that's where the founder is. And we want our founders to live full lives. And our founder, V, wants to live in Portugal. I don't blame him. It's a fabulous place to live. But we can then make it affordable from both a cost and a time point of view, so people can actually get therapy to fix their shoulder. I mean, this is a time, this has been a problem from time immemorial. This is why healthcare is becoming, dynamic. Livongo Health is a company we hatched 5 years ago. We sold 6 years ago. We sold it 2 years ago for $18 billion. But the reason why it works so well is it allowed us to control a very chronic problem, which is diabetes, which is an enormous burden to both families to take care of themselves, to do it, old and young, and also our healthcare system. So we have been able to use this responsible innovation to take us to places where we're creating companies that not only have fabulous returns for our investors, but also doing well.
Extremely helpful insight, David, around your philosophy at General Catalyst. Look, many of our investors at Moonfair, they, are asking themselves, what I'm seeing in the market, the upcoming recession, or probably we are, even in the US already in a recession, the inflation increases, and what is your read? And I know no one can forecast the future, but have we seen, so to say, already the bottom of the market when it comes to valuations in the private sector, and why is it now a good time to invest in venture?
Great question. Venture capital has always stood out for several reasons. Number one, this is not a self-serving comment. There's only a handful of firms that people want to invest in. There's only a handful of firms that throughout the globe have produced long-standing returns that justify a venture capital investment. What do I mean by that? We do not predict liquidity for 10 years in our funds. So if you're going to give us money, it could be less, but we want to make sure, most funds fully liquidate at the end of 10 years, but usually not before that. So if we're asking our investors like you and your investors, individuals, to give us money, the returns have to justify the illiquidity and the volatility of the market. And over time, venture capital has just outperformed because it's in the innovation curve. The creativity is built around the following thing. If I had a chart, I'd show you. But let's imagine this is a chart, okay? Value creation in venture capital starts at the bottom with companies that have revenue. If you have revenue and you have a product, you've created value. If the company can show over time that it's going to have positive EBITDA, the market will reward it, even if it takes 5-10 years. The next piece of value creation is what we call strategic value, which is what we just saw, with the purchase of Figna last week. It's a very good company, but the acquirer Adobe, paid 50 times revenue for it. I mean, in one of the worst, markets. Why? Because it was a perfect strategic fit for what Adobe needed. The next piece at the apex of value creation in venture capital is what we call SOA, scarcity of assets. It's one of one. It's a business like a Stripe, or it's a business that is so valuable because there's only one or two of them, and therefore the market will reward it. So there's no other industry that's set up that way. Every other industry is, what is the value of an asset? What is the value over a long period of time in terms of DCF or TAM? We just don't use those words in venture capital. It's irrelevant. It's a footnote in our analytics about a business. We used to say, if you use the word TAM, you have to put $5 in our charity bucket, because the greatest new companies in the world don't have TAM because they're creating a new market, right? And so the creativity has to be around finding new and creative things and then focusing on that apex. So there will always be a market for companies that have high strategic value and scarcity of assets. And you just don't know how long they take to build. Ergo, you don't know what market you're going to be going to market with. But that's why you need the ability to stick with a company through a longer period of time to create more value. That sounds like a typical answer that I'm saying. What about the real markets now? I think the markets now, we got a bit overzealous of pricing companies. We just very simple metrics. A high growth SaaS company that was in the rule of 40, which I could explain, raising money at 20 to 30 times revenue in a year ago. Now that number has been cut to 8 to 10. Why? Well, there was a lot of dollars deployed without liquidity that gave proof to that value. That's the first thing. The second thing is, certain companies, at the end of the day, you've got to show that, yes, this is a high growth company. It may have a high burn, but it's got to be able at some point to show that it will have a margin and an EBITDA that will reward it either as a strategic purchase to some company or as a public company on its own. And what was happening is we were pumping too much money into companies without regard for when that liquidity was going to come. In bad markets, everybody always pulls up this one chart, which I, of course, don't have, but I can try to articulate it to you. The best companies in the world over time have gone from inception to public companies in usually 5 to 7 years. And what happened, and this is very tactical what I'm saying, is over the last 5 to 7 years, we've pumped more money into companies and had them avoid the market metric and the market test of the value of that business. Think about it this way. Would you rather go shovel snow at 6 a.m. or go for a walk on the beach with 80-degree weather? And it's a lot easier to raise money from other investors who are loving you than go face a market and deal with being public or go to market and sell it. And we all understand that. We're all complicit in doing that. So we just created an overhang of having too much money in too many companies. That's the direct answer.
So David, is very much resonating also from a valuation, but also when it comes, to the long holding periods of companies. We exactly seeing this compression in the markets. Take B and C rounds, Q4 2021. Partially we saw 44x forward-looking revenue as a valuation, and that came down dramatically. So we saw that the markets adapted, which of course offers opportunities. And to your point, this is exactly the reason of being for Moonfair, this unprecedented value creation that's happening in private markets, because they are kept private for a much longer period. And what is left for public markets later, very late in the cycle, is not what it used to be when the Googles and Facebooks and Apples came to play publicly. So one of the reasons really to invest into private equity and into venture. It's all about picking the right trends and companies. You said it. When you now think about certain sectors, certain technologies that are upcoming, what you can share here with the audience where your main focus is, where you believe the new emerging themes are coming from?
Sure. Let me just add to the last point about market timing, because I want to make sure I answer your question. Why is now a good time to invest in venture? For a couple of reasons. Number one, I think there'll be less money in the marketplace, and I think valuations will justify a very good opportunity for returns. The second part, for firms who have scale like ours, is we can double down and buy into our best companies at significantly better prices than we could before. And number three, there's an opportunity, which is, again, I'll get very tactical, to allow people to upgrade their currency. Let me explain what that means, if I can. A lot of our businesses you would not see, but are built as companies in a vertical, and very often we'll do tuck-in acquisitions to build the product roadmap of those businesses. It's one of our strategies. And right now you have a lot of good companies with good tech teams and potentially good products that are stranded assets, meaning they are not going to get more money into them. There's no liquidity for them. And when we have larger companies that are doing well, can allow those companies and their investors a chance to upgrade their currency, meaning they can have our currency of the deal that we're in versus the currency of the deal that they're in. And that's a very effective tool in a lumpy market like we have now. And that's where a lot of fortunes are made, because you build great teams, because there are great people out there that just don't have an opportunity to go forward, but on a larger platform they can. And in a market like now, you can really accelerate your growth to be able to do that. So there are 4 or 5 areas that are very core to us right now. Number one is healthcare. We have one of the largest healthcare businesses in the tech world, and the reason is there are 3 areas of that technology has really impacted of healthcare. Certainly on the delivery side, whether it's online or through telemedicine, has been fantastic. Number 2 is on drug discovery and everything in around bringing drugs to market. We're able to significantly cut the cycle time of how products and pharmaceuticals will come to market. And then the third is, especially in America, there's a complete rebuild of our infrastructure. Ironically, again, intersection of films, one of the things that happened during COVID is the system just melted because it wasn't built around a common infrastructure that was capable of scaling. So all of that stuff has to be built. So again, sometimes you get lucky. We made films about where these problems were, and then we're trying to build those companies, at the same time. So that infrastructure has to be rebuilt from stem to stern, using digital capacity to do electronic medical records. We had 2 companies that totally dominated from the beginning of the Stone Age to recently how medical records are handled, and it was all basically a 1.0 tech platform. We're building a 3.0 platform to allow agile information and data to flow between hospitals, doctors, and patients, the same way it does in any other industry, but it never existed in healthcare. Another area which has really been helpful is doing data analytics around healthcare to allow predictive outcomes, so that we have a better understanding of what therapies, what treatment, what diagnostics can work in today's day and age. The third thing is what we realize is, as much as the pandemic was a horrific situation for all, we were able to bring drugs to market very quickly, and the reason is the scaffolding of all of those vaccines was built over the last 10 years. Those weren't drugs that were started when the pandemic hit. That scaffolding had been built to do other types of vaccines and pharmaceuticals. And having that platform now in place, we're going to be able to build more opportunities to create solutions for people. And then the last point is we need to do this fast and at low cost. We can't have a system where only wealthy people have access to really good healthcare. It creates a downstream problem that is an extraordinary issue, not only in the fundamental fairness of humanity, but what it costs, businesses and people in their lives, and we have to change that. So number one is going to be healthcare, first and foremost. The second is financial services. And I will, we've gone now 34 minutes and we haven't used the word crypto. So let me get to this now. We believe that there is a convergence happening now between what we would call, the digital fintech world, crypto and blockchain, and traditional financial services and fintech. And this is going to be the most exciting. If people thought of crypto as being tokens and, prices of tokens going up and down and all that, that was just the beginning of the show. What we've built, which is really good, is digital rails that allow you to move money, make transactions, buy stocks, get mortgages, have proof of concept, which is extraordinarily valuable, but it's just starting to be used in a mainstream way that's not speculative. And this is going to change fintech forever. And this is going to be a massive situation. We still use a mag stripe and for a credit card. This was invented 50 years ago. It still works really well, but think of what it takes. There's no information coming between people. There is no, it takes 3 days to get remittances. There's no live information, and the cost is extraordinary. So all of this stuff has the opportunity to get fixed over the next couple of years. Now, again, wearing my, responsible innovation hat, this will make a much better society and economy because it'll allow access to everybody, for people. I mean, look at this. This is like kind of like me now moving into, into you all. Why do we, want you all as partners? Because you began by saying you are democratizing the access to returns. Up until you came on the scene using a digital platform, which is fintech, the average investor didn't have access to the extraordinary returns of General Catalyst and other firms like ours. Why? Because it was, only available to wealthy people because of the way the system was set up. That's not fair. We want everybody to have access if they understand what we're doing. And so I look at what you're doing as an absolute, what Moonfair is doing is a breakthrough technology to democratize access to high return assets in venture capital. So I need to go no further than that. Pretty good. Number three, so we've talked about healthcare and we've talked about fintech. The third area is around security. And security is as broad as you want it to be. It can be cybersecurity, it can be food security, it can be anything that technology allows us to do. The fourth thing is we have to figure out where we're going for the quality of work. It's not just, Zoom. I mean, it's pretty great, right? You and I are sitting 6,000 miles apart. I'm on my laptop. You're sitting somewhere, and we're having a great conversation. I wish I was with you live, but this ain't bad, right? So we want to be in a position where we're able to improve the quality of work, not only because people want to work from a variety of different places, but we got to democratize work as well. We need to provide access to people to make a living in a variety of different ways, and therefore raise the ability of an entire generation and an entire economy and an entire community to do a better job with the work that they want to do. And then the last place that we really are heavily focused on, which has been a great place for us to focus on, is just the focus on allowing people to have access to information in a variety of different places. We're building a lot of businesses that we're building a lot of companies that allow businesses to have more live data on the businesses that they're building. And this allows us to better utilize all the tools that businesses can grow to make them more efficient, more profitable, and more predictable in the way they do things. That we could, within that world, we cover a lot of base.
David, I can't say how much it is resonating what you're saying. Look, this democratization theme, it's at the core of our hearts. It's just unfair, as you said, that, in simple words, only the rich or institutional investors have access to assets that they should have. Blockchain is probably one of the drivers of one of the largest disruptions in financial history. This is not about crypto. This is much more, and there's more to come. Let me ask you a difficult one. The other day we had Vinod Khosla here in our deal talk, and I was asking him, when you're an entrepreneur and your company becomes successful, you have to see something, this is what he said, that others don't. And of course, that applies also if you are an investor in venture capital. And you laid out a couple of great themes. Is there any systematic approach that you are taking at General Catalyst, or you and Joe as founders in driving visionary people in the firm? Is there any systematic approach to identify, successful sources of innovation?
Yes. You mentioned Vinod. Vinod is one of the rare venture capitalists who has a very high slugging average. Meaning, if you're going to this is a great way probably to look at it. I apologize, an American baseball expression, although we just had one of the great home run hitters hit his 61st home run last night. If you're going to be a successful VC investor or firm or fund, you need outsized returns. So let's use Vinod as an example. And I know him and his partners quite well, and I have deep respect for them. If you looked at their portfolio, or you looked at our portfolio, or any other successful venture firm's portfolio, what you would see, and this is a great thing that you've asked me, you would see a handful of monster returns. And at the same time, like a slugger, you're going to strike out a couple of times. And what you can't do is lose your edge through having things don't work out. Let me explain what I mean. If you ask me what my definition is of failure, it's not going for it, or doubling down at the right time, or not right-sizing an investment. It wouldn't be making an investment that didn't work. We just don't know that. So you've got to have the fortitude to be able to make investments, right-size the bet so that if it doesn't work, it's not catastrophic to your investors, and then really understand what's happening in that business. Stay close to that founder. This is not a passive business. So when you see the company start to break out, you're in a position to help that founder achieve success, but also, frankly, to be able to put more money in. In terms of the characteristics, I would say there are 5 things that you look for. Number 1, a founder has to have the ability to articulate their vision. If they can't say what they're trying to do, it's very difficult for them to be able to recruit a team, raise money, get customers, etc. And in doing so, they not only have to be able to articulate a vision, they have to be able to sell. It's a very competitive market. It's a competitive market to raise money. It's a competitive market to get customers. It's a competitive market to recruit teams. The second is, can they build teams? Is this a person that is going to have enough leadership and creative vision that he or she is going to encourage other people to join them in their journey? Great people are employed. They're not unemployed. You're going to have to take people from one place and bring them to you. In order to do that, we've all been in the presence of charismatic leaders who paint such a great vision for what they're trying to do that everybody wants to join them. And that's a very important part of a founder. The third is, do they listen? Not that, listen to say, okay, you should wear a white shirt or you should wear a blue shirt, or you should do X, Y, and Z. It's, do they understand the market? Do they listen to what they're hearing from customers? Do they hear what do they listen to the engineers that are telling them things? I didn't say do what they listen, but listen and use that as part of the quantitative analytics that they in their mind do to determine what direction they're taking their business in. This is very important. The person that's just dogmatic, damn the torpedoes, they're going to do it one way. Unless they're right, it's really hard to pivot. And you want people to have that ability to pivot. You want them to believe and they'll keep working at it, but they got to be able to listen to other people around them. Number 4 is something that is so important to me. They have to love their product. I played golf last weekend with a friend of mine that owns a very large, CEO of a very large public sports equipment company. And we were teeing off, and we literally almost missed our tee time because he was telling everybody, this is a big company, Under Armour, to be honest. And it was Kevin playing. And we almost missed our tee time because Kevin is going on and on about the shoes that he's wearing that Under Armour just made for golf. And we're like, Kevin, let's just tee off. We'll talk about it. No, you guys don't understand. This shoe does this, this, and this. People have to love their product so much that they're appalled that people don't want their product. Doesn't mean if they get pushback, they don't listen, but they got to love what they're doing so much that they believe so much that they become just such an advocate for what they're doing. And then the last point, which is important, is we want people that are going to be responsible with capital. This is something you often don't know until you get into the game. We want people to spend money responsibly, but we want people to spend money on the right things. And I think you can understand what I'm saying with this. Hire great people, build great products, but stay focused. You can't boil the ocean. And what we want people to do is be responsible with capital. And I mean dollar capital and human capital to build a business. You can't go so wide in what you're trying to do that you literally can't create and bring a product to market. So those are the types of things that we do to evaluate. We often don't care what their past is because very often you're dealing with founders whose last job, may have been, working at a company for 2 years, and they may be right out of college, or they may not have gone to college. And what we're looking for is that intensity that they bring in the 4 areas I just mentioned. And if they can convince themselves that they have those things, not just us, then we want to do it. And by the way, it's the same way here at General Catalyst. Our firm has grown and prospered not because of Joel and me. It's prospered and grown because of the leadership of the people that we've brought in. We were very lucky. 19 years ago, we hired a brilliant young guy named Montaneja, who's now our CEO. He's been with us for 19 years. He's learned the good and the bad of what we did in the past and taken that with his own leadership team to build an extraordinary firm. General Catalyst today, literally today, is an extraordinarily different firm than it was 20 years ago, 10 years ago, 5 years ago, 2 years ago. Why? Because this is the crazy thing about VC, okay? We claim that we're in the business of supporting and encouraging great young people to go build businesses. Yet often in firms, they don't do that within their own firm. And what we always wanted to do is make sure that our firm is being led by a team that's extraordinarily focused on what the current issues are in the market to build businesses. And as a result, I can sit in front of you and say, when you talk to your clients, I am comfortable that the best leadership team in the venture capital world is sitting leading General Catalyst. And what a joy for me and Joel to see the firm that's been built, not by us, but by a lot of people. So it's not just sharing economics and sharing, accolades. It's sharing leadership. It's sharing decision-making. It's sharing visions. And when I look at some of the stuff that this young team who's been with us for a long time has done over the last several years, it's mind-blowing. So the best venture capital investment we ever made is investing in the young team that has built and will continue to build General Catalyst.
David, thanks so much for the insights. Allow me to finish up our session with a personal question, and probably we have 1 minute for the answer. What would you advise your younger self?
Wow, that's okay. If you were talking to David 20 years ago and David today was talking to David, okay, let's leave venture capital aside. Three main things would cover this. Number one, really be tough on triaging people, and spend time with extraordinary people, and don't waste your time with people that don't matter. Life is so complicated and drains so much energy. You need people that give you energy. Like, I'm being honest with you. I don't know how long we've been talking. I'm more excited getting off the phone with you now than I was a half hour ago when we started. You've brought energy to me. So find people that bring energy, don't take energy away. The second thing is keep your true north. And I think we've done that, but I often have to be reminded of that. And I'm very blessed to have partners and a wife and now kids that keep that true north for me. Don't vary from that. Stick to what you know and believe in, regardless of what the consequences are. The third thing is there's always going to be ups and downs. And what you have to understand is that everybody around you is feeling the same way you are. And the times to lead are when you're in difficult situations. I know I talk in fours and fives, but I have ADD. So let me just give you the 5 things that I believe in. And these are the things that are the culmination of my 20 years of doing business. And this will answer your question. Number one, which is important, is no one's spared. Everybody has stuff that happens to them. You're not perfect, and nor is anybody else. So understand when there are problems, other people have them too. Just work through them. Don't let them take you down. Number 2, adversity does not teach character. It reveals it. Step up for people when they need you, even if it's difficult. And remember that. Number 3 is with power comes responsibility. When you're given the opportunity you and I have, and other people like us have, make sure that you take care of those around you in an extraordinary way. Number 4, pay forward. Don't worry about keeping score. You don't have to do me a favor for me to do a favor for you. Anytime I have an opportunity to do the right thing by people, just do it. It'll pay you back tenfold. And that's got to be a true north. And I think if you keep those things in focus, those are the lessons that I've learned over the last 20 years.
David, look, this has been terrific and so inspiring. Thanks a ton for being with us, and towards the audience, thanks a ton for listening into it. Look, if you are interested to learn more about Moonfair, if you want to get access also to previous deal talks and the insights, if you want to be informed about upcoming events, or just look what's on our platform, please join the Moonfair community of more than 40,000 people, professionals now globally. And as an FYI, our next deal talk will take place on October 21. I'm delighted to have Justin von Simpson, managing partner from HG Capital, with me. So there's more to come. Again, thanks so much, David. It was terrific. Hope to meet you in person soon and to continue our dialogue. And thanks a ton towards the audience. For
one last comment before we hang up.
Of course.
and I mean this sincerely, a firm like ours has the opportunity to choose its investors and partners. And one of the reasons why we're so happy with having you as a partner is you understand the journey of founders and the fact that you're offering people the kind of returns that they can only get through venture capital. The democratization of what we're doing is extremely valuable. So when we think of responsible innovation, when we think of the 5 things that I mentioned matter to us, Moonfare is an extraordinary partner, and it's an honor to be here with you, and it's an honor to call you my partner. Thank you very much.
David, thanks so much. Really appreciate it. And I can only share as an honor to have you and be a partner with Jungle Catalysts. Thanks so much, audience, and hope to see you all very soon.
Ciao.
Ciao.
Thanks for listening. For more episodes, search for Deal Talk wherever you listen to your podcasts. Want to know more about investing in private markets? Visit moonfare.com.